Welcome back to Tesla Daily News Podcast. Today is Monday, January 26, 2026, and we've got a big stack of stock-moving Tesla headlines. Robotaxi in Texas, a major shift in Autopilot and FSD pricing, fresh earnings expectations for the fourth quarter, and new competitive pressure in Europe. Let's jump in. Story 1. Tesla's robotaxi narrative just got a lot more real. Austin is the test case investors have been waiting for. The hook here is simple. Elon Musk says Tesla has begun offering paid robotaxi rides in Austin with no human safety monitor inside the vehicle. The context is that autonomy is the single biggest swing factor in Tesla's valuation. If investors believe robotaxis are a near-term reality, Tesla looks less like a cyclical automaker and more like a software and platform company. Here are the details from multiple reports. Musk posted that Tesla's robotaxis, sometimes called cybercabs, are operating in Austin without a person in the car, and that expansion is expected across the US by the end of 2026. European rollout is also being discussed, but regulatory approval is the bottleneck. The impact for the stock comes down to two questions. First, is this truly driverless at scale, or a limited, geofenced program with careful constraints? And second, can Tesla monetize it quickly enough to matter for 2026 financials? If Tesla can prove repeatable safety performance and expand the operating domain, Wall Street will likely start modeling a services revenue stream that's less tied to vehicle margins. But if this is small-scale or heavily supervised behind the scenes, the market may discount it as yet another pilot. The investor takeaway. Watch for hard numbers, fleet size in Austin, ride volumes, operational design domain limits, and any regulatory engagement. The market will move on evidence, not vibes. Story 2. Tesla is effectively turning basic autopilot into a paid feature, and that's a major monetization pivot. The hook. Tesla has discontinued its basic autopilot bundle for new orders in the US and Canada, pushing buyers toward the full self-driving subscription. The context is margin pressure in EVs. When vehicle gross margins are under stress, recurring software revenue becomes a higher quality earnings stream. Investors generally reward that, but only if take rates rise and customer backlash stays manageable. The details reported, to keep features like auto steer, owners now need the FSD subscription priced at $99 per month, or they can buy FSD outright for $8,000 before February 14th. Musk also suggested the subscription price will rise over time as the system improves. The impact. This could lift average revenue per user and smooth revenue volatility, which tends to support valuation multiples. But it also creates risk. Buyers may perceive Tesla as removing previously included capability, which could hurt demand or brand sentiment in a competitive market. One nuance for investors. If Tesla increases FSD attach rates even modestly, the incremental gross margin could be meaningful because software margins are typically far higher than hardware margins. Takeaway. Track whether this change increases FSD adoption in the first quarter and whether it affects order rates for Model 3 and Model Y in North America. Story 3. An insurance signal investors shouldn't ignore. Lemonade is cutting rates by half when Tesla's FSD is driving. The hook. A U.S. insurer says it will offer about a 50% rate cut for Tesla drivers when full self-driving is actively steering. The context. Insurance pricing is basically a real-time, market-based judgment about risk. If insurers are willing to discount premiums significantly under certain driving modes, it's an external validation that could support Tesla's autonomy safety narrative. Details. The report indicates the discount applies specifically when FSD is steering, implying the insurer is using telematics or usage-based logic rather than treating the car as a static risk category. Impact. If more insurers follow, Tesla could use total cost of ownership messaging more aggressively, not just lower fuel and maintenance, but lower insurance too, potentially supporting demand. It also helps the investor story that autonomy has measurable safety value. Takeaway. Watch whether Tesla's own insurance offerings and third-party insurers broaden these programs, and whether regulators or consumer advocates raise questions about how the discounts are applied. Story 4. Earnings setup. Tesla is signaling fourth quarter expectations around revenue, and investors should focus on margin and guidance. The hook. Tesla has circulated analyst estimates ahead of the fourth quarter earnings call, with revenue figures being discussed around $24.5 billion. The context is that in this tape, the market is less forgiving about deliveries up, margins down. For Tesla, guidance and profitability trajectory matter at least as much as unit volume. The key detail we have from today's inputs is the revenue figure being touted, but the bigger point is what will drive the stock reaction. Gross margin in autos excluding regulatory credits, operating margin, free cash flow, and any commentary on pricing and demand. Impact. If Tesla prints revenue around expectations but signals margin stabilization, the stock could respond positively. If Tesla beats revenue but shows further margin compression, the market may treat it as low-quality growth. And if guidance for 2026 is cautious, especially around deliveries, it can pressure the multiple. Takeaway. For the earnings call, listen for three things: Model Y and Model 3 pricing strategy, Cybertruck ramp economics, and any quantified update on robotaxi scaling plans. Story 5. A bearish analyst call is gaining attention, and it's tied to delivery expectations. The hook. HSBC is reportedly warning of a worst-case scenario for Tesla stock and pointing to delivery performance versus expectations. The context. Tesla's stock often trades more on narrative and forward expectations than on any single quarter's results. So when a large bank frames the setup as massive downside, it can move sentiment, especially into earnings. Details from the report. It cites fourth quarter 2025 deliveries at about 418,000 vehicles, around 3.7% below market expectations and about 5.2% below HSBC's forecast. Impact. This matters because it pressures the re-acceleration story. If deliveries are under consensus and pricing remains competitive, investors worry about demand elasticity and margin trade-offs. Takeaway. Don't overreact to one bank's headline, but do watch consensus revisions. If multiple firms cut delivery growth expectations for 2026, Tesla can derate quickly. Story 6. Europe is getting tougher. Volkswagen took the top EV brand spot, even with Model Y still leading as a model. The hook. Tesla reportedly lost the number 1 EV brand position in Europe to Volkswagen in 2025. Context. Europe is a battleground where policy, competition, and consumer preference all collide. Losing brand leadership doesn't automatically mean Tesla is failing, but it does signal competitive intensity and potential pricing pressure. Details cited. Volkswagen sold about 247,900 EVs in Europe, Audi about 223,000, and Tesla just over 203,000 units. At the same time, Model Y is still described as the best-selling EV model in Europe. Impact. For investors, this is about mix and margins. If competitors broaden lineups and undercut pricing, Tesla may need to respond with incentives, which can weigh on automotive gross margin. It also raises questions about whether Tesla's refresh cadence and product breadth are sufficient in Europe. Takeaway. Monitor European registration trends, pricing moves, and how Berlin production is utilized. If Tesla defends share with price cuts, watch margins. If Tesla holds pricing, watch volumes. Alright, let's wrap it up. Today's themes are clear. Tesla is pushing harder into software monetization with the Autopilot to FSD shift. Autonomy headlines are heating up with paid robotaxi activity in Austin. And the market is heading into earnings with a mix of optimism and skepticism, especially around deliveries and margins. Add an intensifying competition in Europe, and you've got the kind of setup that can move Tesla fast. For tomorrow, watch for any new details ahead of the earnings call, especially updated consensus numbers, margin expectations, and any concrete data from Austin robotaxi operations. If you want this breakdown every single trading day, subscribe to Tesla Daily News Podcast and follow us for the daily, investor-focused Tesla update.